Hey everyone, welcome back to another dividend investing video. That's right folks, we are back, finally, right? It's been a couple months and I had to take a little break from making these videos for a few reasons. But one thing I've not taken a break from is my weekly investing. Between my Roth IRA, where I buy weekly ETFs, and our taxable public Dividend Growth Income Portfolio, I've been continuing to stack my investments and build that sweet passive income each and every week. Now, since it's been a bit, I thought I would make a quick video to go over the top 5 stocks I hold in my public account right now. I'm Nick. This is the Dividend Growth Income channel, and I thank you for tuning in. Now, look, I'm just a regular guy who's into building up passive income via dividend growth investing. I'm definitely not a financial advisor or anything like that. Nothing in this video constitutes financial advice. Just remember that investing in the stock market does carry some risk. I'm just here to share my own journey. If you could, smash the like button and subscribe, and leave a shout out down in the comments. It really does help in spreading the amazingness that is dividend growth investing. So a few months have passed since an update on this portfolio, and by the way, I really appreciate all the kind comments I've received over the last couple months. I'm okay. I just had to take some time away from making content. Life can get pretty hectic. Not bad hectic or anything, but doing these videos does require a pretty substantial time commitment that was getting difficult to maintain, just with all the other stuff I had going on. But I could not stay away for too long, guys. I am back. Now, in the last update, our dividend growth income portfolio was sitting around $22.5 thousand in value and was projected to pay about $650 annually in dividends over that next year. Now, I have been investing consistently since then. The market has been up and down and up. Maybe it's coming back down now, but the dollar cost averaging does not stop. Each dollar invested is $1 closer to my own financial independence. Now, today, the value of the fund is at $27,562, and this is mid-June 2024. Annual dividend income is pushing $800 a month. Things are coming along nicely. Now, I'll be putting out a more comprehensive, let's call it mid-year portfolio review, where I'm going to step through each position here and share my thought on where I stand with each one of these stocks. Now, today, I'm just going to highlight the top 5 individual stock positions in this account. These are really the core foundation stocks of this portfolio. I'm building my portfolio around these companies. Now, the top 3 overall positions, they're actually ETFs. They're exchange-traded funds. This sets the foundation of diversity in the portfolio, kind of a passive, hands-off kind of investment. I have 2 dividend ETFs, that's VYM and SCHD. Then I have the Vanguard S&P 500 ETF, VOO, and this is actually my single favorite investment. All of these have been doing pretty well for me. VOO especially has been up over 25% over my investment in that. Altogether, these make up around 20% of the portfolio weight. And I'm good with that because the remaining 80% are in individual stocks, and these are the top 5 positions. So starting with the largest individual position in the portfolio, that is Broadcom, ticker AVGO. Broadcom is both my highest weighted stock, and it got there by being my top performing investment in the portfolio. I don't even own an entire share of this company. I have 0.635 shares of Broadcom valued at $1,101.75. This makes up 4% of the portfolio. Broadcom, they're into designing and manufacturing semiconductor devices. These are the kinds of chips that are used in several applications like networking and wireless communications, personal electronics, automotive, and a variety of industrial applications. Just over the last month, shares of Broadcom are up over 30%, much of that in the last week, on their latest earnings report and news of an upcoming stock split. Now, today's shares are trading near their 52-week high at $1,735.04 per share. Thank heavens for fractional shares, am I right? Year-to-date, shares are up over 55%. So yeah, if you've been waiting on the sidelines for a dip on this one, we've just really not gotten that, right? And then you look at the 10-year total return. It's pushing 2,600% total return over the last decade. This includes price growth and dividends. And Broadcom has been an excellent dividend growth stock over the last decade. Now, today's shares are yielding about 1.21%. Quite a low yield, especially when compared to its 5-year average of just over 3%. 60% below the 5-year average. And that's about what Broadcom was yielding when I first opened this position in September of 2022. But with this spike in share price, of course, that causes the yield to subsequently drop. But as dividend growth investors, we should be focused mostly on that total return, and dividend growth Broadcom has just been stellar in both. I don't know how else to say it. It's trading richly at the moment. Shares are at a forward PE of 31.8. I don't know if I could see myself opening a position at these levels, but I sure am glad I did when I created this portfolio. Just wish I had bought more of it. Story of my life. Avgo pays that quarterly dividend in the months of March, June, September, and December, paying $5.25 per share for a total annual payout of $21 per share. Broadcom has been paying this dividend uninterrupted for 13 years and growing it each year during that time, and at a massive clip, with a 5-year average annual dividend growth rate of 19%. Love it. Now, as for dividend safety, Broadcom has a Simply Safe dividend safety score of 67, rated safe, unlikely to see a dividend cut. Its payout ratios are looking fine to me. Both are within where we want to see them. I think the majority of the risk here is just the cyclical nature of these semiconductor companies, but has been more than a solid investment so far. As I look at my own position, I'm up over 136% on my investment. And these shares also pay about $13.34 annually in dividends. So while that 1.21% yield is low on my actual investment, my yield on cost is actually a respectable 2.86%. Well, much closer to that average. So I will continue to be a believer in Broadcom, holding on tight. Maybe it'll continue to go up as we head towards that stock split. Now let's talk about Broadcom, ticker AVGO's upcoming stock split. Now on June 12th, Broadcom announced it was going forward with a 10-to-1 stock split. It will commence on July 15th, 2024. And this means for each single share of Broadcom will be split into 10 smaller shares, thereby increasing the number of shares while the price per share will decrease proportionally. Note that this doesn't change the fundamental valuation around Broadcom. The market capitalization of Broadcom will stay the same. The value of the company does not change. Stocks like this that have run up a lot, it's easy to get caught up in the FOMO, but that is a recipe for pain. I urge caution. Stock splits have become trendy, but with fractional shares, today it really truly changes nothing, unless you're trying to write options. So if you're a shareholder of Broadcom, congrats. I'm happy with it myself being my largest position. I don't really see myself adding to it heavily for now, but I'm rating this hold a very strong hold, looking for opportunities to add to it, obviously. So guys, let me know down in the comments, what is the largest position in your own dividend portfolio? All right, the second largest position in the portfolio is United Health Group Inc., ticker UNH. I have 2.212 shares of UNH, valued just under $1,100, making up 4% of the portfolio. UNH is a diversified healthcare company that offers consumer-oriented health benefit plans, as well as services for employers to provide health coverage to their employees, among many other things. This is really, truly a healthcare conglomerate. It's a massive company. Shares of UNH are down about 3% in the past month. Shares are hanging around the 52-week midpoint, trading just below the $500 mark. Zooming out a little bit year to date, we're down about 5.5%. Interesting, yeah? But on this channel, we are all about long-term investing. Let's see how United Health has stacked up over the last 10 years. Over the last decade, UNH shares have brought back a total return of 607%. This is almost 3 times what the S&P 500 has brought back in that time. So this has been a fantastic, excellent investment. As for that UNH dividend, shares are yielding 1.69%. So it's on the lower yielding side of things, but check it out, 17% above its 5-year average. So kind of high for this stock, and this was a potential indicator of an undervalued stock. Likewise, from a PE ratio standpoint, UNH is trading at a discount to its own 5-year average with a forward PE of 17.5. And this is just a tad higher than the healthcare sector median as a whole at 16.6. So I see some indicators that this might be a decent time to be buying UNH and continue building this position up. UNH does pay dividends every quarter, the months of March, June, September, December. Ex-dividend is on this upcoming Tuesday, paying out $2.10 on June 25th. That's per share, making a total annual payout of $8.40 per share. Now, part of that huge total return we are seeing is fueled by that stellar dividend growth. We have 31 years of uninterrupted dividend payments, 14 years of dividend growth streak, and that's 16% average annual dividend growth, average over the last 5 years, each year. And just a couple weeks ago, we were given word on their latest dividend raise. It's a 12% increase. So this one to me is just a no-brainer for dividend investors with some time. We have a Simply Safe dividend safety score of 99, ranking it among the safest dividends in their sector. They're the largest health insurer in America, and looking at their payout ratios, everything's looking solid. What they need to do is continue growing their sales and their free cash flow per share, as they've been doing. As for my own performance, I'm up 1.5% on this position, so just about flat. It does pay me close to $10 annually in dividends as well, so I would rate UNH a buy right now. This is one I'm going to continue to accumulate here this summer. It's going to continue to be an anchor in his portfolio, and for a dividend growth investor focused on total growth, dividend growth, UNH is just a no-brainer. The third largest position in the portfolio is Lockheed Martin, ticker LMT. So I have 2.334 shares of LMT. This is valued at $1,069.77, making up 3.88% of the portfolio. Lockheed Martin is a defense contractor, an aerospace company. They primarily operate as a contractor for the U.S. government, as well as foreign military sales contracted through the U.S. government. And I get this type of investment might not be for everybody, but I understand the need for such a company as it's vital to the national security interests of, this is Americans, really anyone living in a free society. But today, shares are trading at $458.34 per share, about $20 shy of the 52-week high. Shares are down 2.4% over the last 30 days. Year-to-date performance is a little better than flat. Shares are priced 1.13% since the first of the year. Zooming out even further, Lockheed Martin has been a better-than-average investment over the last decade, outperforming the S&P 500 on a total return basis with a near 260% total return, while the S&P returns 232% over the same time frame. Let's take a look at timeliness in terms of dividend yield theory. Shares are trading at 2.68%, and this is almost exactly in line with the historical 5-year norm, and by this metric, the stock looks like it's reasonably valued. Lockheed's forward PE is also sitting quite close to its 5-year average, slightly above, with a forward PE of 17.3. It's also at a discount to the industrial sector as a whole, which is trading at 19.1. Now looking to the Lockheed Martin dividend, it's paid out quarterly in the months of March, June, September, and December, paying $3.15 per share for a total annual payout of $12.60. Lockheed Martin has a terrific track record as a dividend stock, paying uninterrupted dividends for 31 years and growing them every year for 21 years consecutively. Over the last 5 years, that's a respectable 8% annual average dividend growth, with its latest raise at 5%. So as the company matures, perhaps the days of double-digit dividend growth is behind Lockheed Martin, but I do see this as a quite dependable growing dividend, maintained and raised through the last recession. Now, from a dividend safety standpoint, Simply Safe Dividends gives LMT a safety score of 84, rating the stock very safe, highly unlikely to face a dividend cut. Another fact I appreciate about Lockheed Martin as an investor is their commitment to share buybacks. They've reduced the share count by 22% over the last decade today, with 248 million shares outstanding. As for my own position, I'm up nearly 2%, so I'm close to my cost basis right now. As I see it's reasonably valued, I don't mind adding to it here. It is paying me nearly $30 annually in dividends, and that's growing. I'd like to see that. My yield on cost right now is 2.8%. The fourth largest stock position in the Dividend Growth Income Portfolio is McDonald's, ticker MCD. In the account, I own 4.13 shares of McDonald's, valued at $1,047.29, making up about 3.8% of the portfolio. Perhaps you've heard of this company. They sell hamburgers and the like, franchising restaurants under their McDonald's brand all over the globe. Over the last month, shares have dropped 6.5%. It's been a rough month for the Golden Arches. Shares are trading around $253.58, only 8% above that 52-week low. And look at this, the shares have dropped nearly 15% over the last year-to-date period. That's about 6 months at this point. Definitely a down year for McDonald's. Zooming out to the 10-year total return, McDonald's has returned a respectable 222%. This just barely underperforms the S&P 500 over the last decade, but if you take a look at the graph there, McDonald's has historically been outperforming this index. This is interesting. Maybe it's an opportunity, maybe not. Let's look at some timeliness metrics to get some better info. So by dividend yield theory, McDonald's is looking to be at a bit of a discount. The 5-year average dividend yield is 2.27%, while today's shares are trading at a yield of 2.63%. There was a unique opportunity there in 2020 when the world shut down, as with many stocks, but other than that outlier, it's about as good as a starting yield as we've seen from McDonald's in quite a while. Looking at the forward PE of 20.6, it's a bit high, but for McDonald's, it's not really that high. And if McDonald's dropped below that PE line of 20, I'd say we're in discount territory for this company. Historically does trade at a premium. I mean, it's McDonald's, right? The 5-year average PE is 25.4. Now, as with my other top companies, McDonald's pays out quarterly dividend in those same March, June, September, December months. And yeah, it makes sense why I get paid so heavy in these months, is all of my top holdings seem to pay in that group of months. Now, I have a dividend coming up in a few days. That's $1.67 per share for a total annual payout of $6.68. Look, we're talking about one of the most consistent, high-performing dividend stocks of the last 50 years. That's half a century, 47 years of dividend growth. For a mature company like this, they're consistently raising that dividend at above average rates. Last October, they announced a 10% dividend hike. And it's easy to see why I want this to be a core holding in this portfolio. We have a dividend safety score of 77 from Simply Safe Dividends, making a dividend cut unlikely. Now, restaurant stocks carry some special risks, and there isn't one out there that has this kind of track record, although there's a couple others that might be worth owning as well. As for my position, I'm down about 5.5% on this McDonald's position, and I've been averaging down this year into the position. I'm absolutely fine with this. I wouldn't mind seeing it drop even more. I'm not opposed to this becoming my top position. I'm in McDonald's for the long haul here, and I'm a huge believer in their brand power. The fifth largest stock position in the Dividend Growth Income Portfolio right now, Chevron, ticker CVX. Now, in the account, we own 6.812 shares of Chevron, valued at $1,039.31. Chevron engages in the exploration and production of oil, gas, and liquefied natural gas, and provide petroleum products to its network of gas stations scattered all over the United States. Investing in energy isn't going to be for everyone. It is a highly cyclical industry, but we're talking about a company that's been paying uninterrupted dividends for over 100 years. That's right. Shares of CVX, they've been tumbling over the last 30 days, down about 7.5%, with shares trading at $152.57 at the time of publishing this video. Year-to-date shares are up just over 2%, and today's shares are trading right around the 52-week midpoint. And from a 10-year total return standpoint, this might be my least impressive stock. Chevron has a total return of 76.33%. The vast majority of that is from its dividends. One thing we can say about Chevron is they're a solid dividend company. This is the only exposure to energy in this portfolio, so it does have its place. I'm not going to bet against Chevron. In fact, I've made it one of my core holdings. From the timeliness metrics we look at, Chevron looks reasonably valued, pretty much in line with its average. We have a healthy dividend yield of 4.27%, making this one of the higher yielding stock pairs in the portfolio. But remember, I prioritize total growth plus dividend growth over dividend yield. That's why you see some of those other positions being in the 1%, 2%, right? Now, Chevron is trading at a forward PE of 11.5, slightly below the 5-year average of 12.2, not by much. Pretty close to being in line with what we would expect from Chevron. So I see it as not at a discount, but also not expensive. When we have a high-quality company like Chevron, I'm fine buying shares at a reasonable value, provided I'm cool holding onto them for 5+ years, which I am. Ideally, I pass these shares off to my daughter someday, right? But we don't just blindly invest and forget. We do keep on top of things, because things can and will change. Like the others, Chevron pays out in the months of March, June, September, and December. Recently just paid out $1.63 per share for a total annual payout of $6.52. Now, the ex-dividend for the next time is going to be around August 19th. And that's a dividend growth track record. They have a 36 years, 112 years without a dividend cut. It's a legendary dividend company we have there, paying dividends since before any of us were born. A respectable dividend growth. Its latest raise, announced last February, was at 8%. Pretty close to in line with what they've been doing for the last 20 years. Gotta love it. Simply Safe does see Chevron. It's a very safe dividend, giving them a safety score of 90. And by the way, that's 10 points higher than the score they give to rival Exxon Mobil. As for my own position, it's down about 2%. I'm down about $20. But in terms of total return, I've actually already collected $34 in dividends from Chevron. And I'm projected to collect another $44 over the next 365 days. So that's Chevron. I'll be continuing to build this one up like the rest of my core positions. The only one I'm hesitant to add to out of this bunch I've gone over right now is Broadcom with my massive gains. But I'll probably add to it just a little bit slower. One thing I've learned over the years is to just be patient, because it does pay off. And just look for those opportunities. And that's why I own probably more than an ideal amount of stocks in this portfolio, because I do dollar cost average every week, and I'm looking to be opportunistic with my investments, right? And then having a nice group of stocks to pick from allows me to do just that. So those are the top 5 stocks in my account right now. Very happy with these being my core holdings, along with a few others. Now, in the couple months that I was away not making videos, I did make one more addition to this portfolio. I added a new stock. And if you follow me on Twitter, you already know this. By the way, you should follow me on Twitter. I guess X, whatever the hell Elon is calling it. That's at Div Growth Income. I do love chatting with you guys. Don't be afraid to say hi. But in the next video, I'm going to reveal the entire portfolio, including its newest holding. And so you'll make sure you're subscribed to see that, all right? We've already collected $269 in dividends so far in 2024 in this account. And the next month, I should surpass what we've done just in 2023. Very exciting stuff, and I'm really looking forward to what 2025 and 2026 and beyond is going to bring for this portfolio. It's good to be back, my friends. We have more to come this summer, lots to talk about, but until next time, keep investing.